Good morning, everyone. Welcome to the Macro Snapshot. We are Wednesday, November the 5th, 2025. Guy Fawkes night, of course. Okay, so let's just see what's going on. We have a little bit of data this morning. And again, the market is going to be focused on this second tier data because obviously we have the US government still shut down. So no JOLTS number, job openings, labor turnover, no non-farm payrolls. But what we do is incrementally, a little bit more of incremental information. We have my birds in the background. We have the ADP employment change coming up at 8:15. As you can see, previous was actually a negative number, which upset the market. Consensus at this point is for, about 20, 25,000, something like that. So again, this is sort of a private survey. This is now the weekly number. It used to be a monthly number, but now the ADP is reporting on a weekly basis. This does not include government jobs. This is like for private payrolls. So, but nonetheless, that's all the market has, and the market will be looking at that to see if the hawkish repricing for the Fed in at the December meeting is kind of justified or not. If this number comes in soft, that could cause the market to reprice in a slightly more dovish way, a cut from the Fed in December. We also get a little bit later on, we get the ISM services. Keep in mind that we had the ISM sort of manufacturing a couple of days ago, which was, I'd say sort of reasonable. We went over those numbers. It was neither sort of horrible falling off a cliff, nor was it in expansion territory. It was, indicating a lower prices paid, an employment situation which was kind of flattish, and new orders which was, a little bit improved, but still not spectacular or stellar. What is interesting, just in terms of the employment situation here, is again we're looking at the employment that's expected to still be in contraction. 47.2 is the kind of the previous number there. New orders is going to be the interesting one, but keep in mind that 70, 75, maybe even 80% of the US economy, people are employed in the broad services sector. So this is an interesting one. So let's put these two numbers together, ADP and ISM, and just see whether the jitters which we saw in the stock market over the last 24 hours are sort of continuing. So let's just also see, we do have at 8:30 the QRA. I can see here the Treasury refunding announcement. That's not expected to bring any particular fireworks. I mean, I've just got a little sort of graphic here which shows, if they were, what's a small chance, less than one probability, according to this commentator, of the auction sizes. So we're going to get on Monday afternoon at 3 p.m. we received the actual overall size of the auction of the issuance. But in terms this time this morning at 8:30, we'll get the breakdown for, like from the 10-year, the 30-year, the 5-year, the 2-year, the bills. We'll get the breakdown of the different durations. That's expected to be relatively unchanged. So auction sizes left the same, and no change in language. No change in language in the sense of not saying that auction sizes in the future will get smaller or larger. So, at that point, fairly neutral for the stocks, maybe in the tens, modest buy, no policy implications, but overall fairly neutral. What would be extreme reactions? Again, low probability, but you need to be prepared, is if they were to increase the auction sizes. Again, with the tariff income, keep in mind, as I said yesterday, the US government is receiving about 30, 35 billion per month of new income from tariffs, which, incrementally is what's that, about 350, 360 billion, 400 billion extra per year, which, on the margins means a less need for issuance. So were they to increase that, that would be very, very unexpected. As they say here, absolute shock to market, be a sell for the stocks, and then the 10-year, and would be a buy for the dollar. On the other hand, if they were to decrease and say, hey, we're getting tariff income, because remember, this is one of the justifications for Trump. He says, we love this income. It means they have to issue less long-term bonds potentially. But again, it's incremental and small numbers. So at this point, they're not expected to decrease the size of the auctions for the long-term bonds. But if they were to do that, that would be, pretty significant. And as they say here, the implications that the Treasury is willing to run at a higher rate than Yellen, the bills ratio. So the bills ratio is the number of those very short-term bills compared to the long-term, let's say the 10 or the 30-year. So if they were to decrease the auction size, that's essentially saying that they're going to be issuing even more sort of short-term bills, which of course would be great for the long end. So you'd be buying the tens, buying gold, buying stocks, and that would be dovish for the US dollar. But to say those extreme outcomes are, less than 1%, not really much a chance for that. On the other hand, what they could do is to keep the auction sizes the same, but say, hey, in the in the future, we can't keep on issuing so many bills. We may have to actually change that ratio back more towards the normal, which means what is the normal? Issuing a few more longer term bonds. And so, that would be not great for either the stocks or the belly of the curve or the long end of the curve or gold. On the other hand, be good for the dollar index. So let's keep an eye out for that. That's happening at 8:30. And of course, the other big thing is we start to get arguments, so both sides of the legal case in the Supreme Court about the legality of the tariffs. I mean, that's going to be a complicated process, but the reality is what the market wants to understand is, are we starting to, even on this sort of day one of that Supreme Court case, we can listen to what the justices ask. So what's going to happen today is what they call the oral arguments, which basically means the spoken arguments. So the justices on the Supreme Court will sort of, pepper the various defense counsels with questions, and that could sort of orient, our understanding of where this case could be going. And essentially, it's pretty simple. We want to know whether the president has the sort of individual power just to impose tariffs, or whether he needs to go back to Congress, which would be a more complicated thing. And that's going to have implications in terms of the tariff income, or not having the tariff income for the U.S. Treasury. And on the other hand, in terms of the importers and consumers, will they have to continue paying those tariffs or not? Most of the commentary I've read is essentially saying that in one shape or form, the Trump administration can rejig instead of using a sort of presidential order, can use various other sort of statutes which actually exist still on the book. So at least 70-80% of them can probably just be reassigned using a different sort of legal justification. Anyway, that's going to be quite a fascinating process. It starts today. Let's have a look at that. If we look at some of the just want to show you, we had a pretty big equity sell-off, and just before we go into some of the markets, we can just want to show you just some of the valuations. There's been a lot of talk about the valuation, especially with Palantir and whatnot, but it is true. We've just got different metrics here from sort of different ways of looking at the US stock market and the valuations. And you can see if we look at trailing, PE, so price earnings, you can see just historically, what I'm trying to do here is to get a historical sense of where we are. And you can see here that, for example, trailing PE, we're getting up to quite high levels. If you look at the Schiller PE, which is basically the cyclically adjusted price earning ratio, so cyclically adjusted price earnings, you can see here that we're getting up towards a 40 level, which is, almost getting into dot-com excesses of the 2000s. So, that valuation metric is high. If you look at the trend, price to earning, also up at an elevated level historically. If you look at the forward PE, you can see we're at a historically high level. Look at the price to book value, that's also high. You look at the dividend yield, you can see that that's the inverse. So what I'm trying to say is here that all of these valuation metrics are high. That doesn't necessarily mean that you sell off on one day. But nonetheless, the market is saying, well, okay, because there's anecdotal evidence. Our company. I was reading something yesterday, essentially saying that not many companies are actually sort of monetizing their use of AI or investments in AI. And at a certain point, the market is saying, hey, with these incredibly high valuations, maybe it's time to trim a little bit. So if we just look at some of the equities, we know that the VIX is pushed up now almost to 20. So, if you divide that by 16, you get the typical, not the typical, but the expected daily move. So we're now well over 1%. So volatility going higher. And you see here, if we look at the ES futures, you can see that they, had a bit of a sell-off. And they closed this sort of gap from that weekend gap from about a week ago. But they did. But what I want to bring into perspective here is it's interesting. If we put on some moving averages, you see that they breached the 20-day, but this is still a very, very strong uptrend. And we haven't even touched, let's say, the 50-day moving average, which is the second one here. We're still, the only technical damage done was minor, and it's on the 20-day moving average. Similar situation if we look at the NASDAQ here. we got down into that gap area. Now, in terms of that sort of upward channel, which a lot of people are looking at, it was overextended. Everyone's looking at the Bollinger Bands, the weekly Bollinger Bands, the monthly Bollinger Bands, for sure. The RSI, we all know it was overextended. So what caused the immediate what was the proximate cause for this sell-off? It's always easy in retrospect to sort of retrofit everything, but for sure the markets were very overreacted. As I say, the valuations, just a real recognition that a lot of these valuations, and symbolically Palantir, which reported a couple of days ago, has a crazy sort of valuation in theory. I mean, when I say crazy, crazy is what the market expects, but we also had sort of a sense that, maybe the new mayor of New York City, Mamdani, he's, sort of a socialist, very much a socialist. Democrats did pretty well overnight in the other elections. So maybe it's just a general sense that the Trump, the nation, the US is shifting a little bit away from Trump, which is not necessarily great for sort of business and the stock market. There's also a sense, with the economy doing, potentially relatively well, this whole idea of the FOMC, the Fed maybe not cutting in December, and maybe even Powell is saying, hey, I'm going to be out of this job in the 3, 4, 5 months. Maybe I'm just going to do what's right for the economy potentially, and not cut interest rates when there's no real need. Maybe Powell's going to try and cement his legacy by not cutting. And I think that sort of implication is maybe filtering through into the market. And then, of course, we've had a lot of fairly frothy price action. I mean, if we look at global equity here, we can look at something like the Kospi, which has been on this incredible tear. Look at all the moving averages here, and that was really, extremely overextended. If you look at all the Bollinger Bands and all of this kind of stuff, so it was due for a pullback. That was getting a lot of run up, just with a certain amount of positivity between on the trade front. Obviously, the semiconductors is a big deal in the South Korean sort of index here. So it did pull back, but it's interesting that you look here, it pulled back just to its 20-day EMA, and also just the blue line here, which is the 38% fib retracement. So just a short term. So you see from this impulse here, the 26th of September, it pulled back, but was immediately bought there. So technically, this is just a little pullback. This is not sort of the market collapsing. Be interesting, a lot of the other sort of global indices also pull back a little bit. You look at, especially in Asia, you look at the Nikkei over in Japan, similar kind of situation to Korea's Kospi. Just a little bit of a pullback, very, very strong uptrend just to the 20-day EMA. So at this point, the bulls, you have to say, is still very much in control. The US, underperforming a little bit, but from a technical position, this is not yet indicating that the bull market is over in any shape or form. What did get my attention? Just want to look here at Brazil. If you look at most of the global markets, everything pulled back yesterday, as we saw in Asia, Australia, the Sensex in India, for example, just pulling that up on there. So a lot of things pulled back, but it's kind of interesting here just to look at Brazil powering to new highs, and this is a very very attractive chart here. All pullbacks are being bought. The Fibonacci retracements are being respected. The moving averages are high, and if we look at a sort of some kind of Fibonacci measured move here, which we'll just put on here. I mean, we could either go for this one or here, even something, just approximate it. You can see here that we're now getting up to, starting to reach first targets, but there is technically a little bit more of a way to go. So just interesting to keep in mind here that Brazil are doing very, very well, and maybe that's a sort of a beneficiary of sort of increased integration with China and the BRICS and all of the commodities and whatnot. But the Brazilian market really on a tear here. So let's keep an eye on that one and see if that gets a little bit overextended like the Kospi or whatnot. So I think all that to say that the stocks, there was just, this combination of maybe, the political landscape moving a little to the left, and, symbolically the new mayor of New York, 34-year-old Mamdani, definitely a democratic socialist. As I say, FOMC, Fed being a little bit hawkish. Now, talking about the Fed, we do have quite a few speakers today. We have Williams, Barr, Waller, Beth Hammack, we have Muslim, Paulson. We have a lot of speakers, so I think the market will pay attention to those, especially maybe Williams, who's considered to have the ear of Jerome Powell. Waller, we know, is still on the short list to replace Powell. Waller has argued, has been relatively dovish in the past. On the other hand, he only voted for a 25 basis point cut, not a 50 basis point cut. So let's hear what Waller has to say. On the other hand, we also have Beth Hammack, who is a known hawk. Will she sort of hammer home the idea that there won't be any cuts in December, or will she be a little bit more equivocal? That would be sort of dovish if she says that she still has an open mind. But anyway, we do have six Fed speakers today, so putting it all together, it'll be interesting to see what kind of messaging we get. Do we get just like, hey, we're data dependent, we're driving in the fog, or maybe we're a bit worried about maybe if the ADP is weak, for example. That's going to be interesting just to see whether that'll open the door to more sort of dovish repricing. Just in terms of looking at a couple of other markets today, just want to keep a look on what did get my attention as well. So when the stocks, selling off, a little bit yesterday, if you look at the 10-year, it had a bit of a pop, but not really much. And that's a little bit concerning. It still says that, the market is happy to be, above 4% on the 10-year here. As you can see here, not really a huge change in equities. If you look at the 10-year, sorry, the 2-year, it did, sort of crawl up a little bit yesterday, but it's given a lot of that back. And so, the bonds in no market, even with a bit of an equity sell-off, to rip too much higher. So still a bit of pressure on the bond market. What I would look at here is also oil. Again, just sort of treading water in a sideways sort of consolidation here, finding it very difficult to push higher. Yesterday, just to recap, yesterday afternoon we got the API, so American Petroleum Institute. We got their sort of numbers for the inventories. Again, a surprise build, 6.5 million on the crude oil. So that was definitely unexpected and is a negative for oil. So that's possibly some of the reason oil is finding it hard to push up. On the other hand, you could say that the refined products, so we had the distillates at negative 2.5, so a drawdown. We also had negative 5.7 on the gasoline. So the refined products was a little bit more positive. So again, just sort of in a sort of balance here, but no real reason to collapse, and finding it difficult to sort of push higher. So this is sort of dead money just at the moment. Finally, just want to have a quick look here at the dollar index. Interesting moment here, pushing above the 200 EMA. We highlighted that yesterday, above the 100, this purple level, so this sort of symbolic level. And as you guys can see here, definitely an area of high volume and sort of overhead resistance here. But this chart at this point, the moving averages, the 20 has crossed over the 50 hasn't yet quite crossed over the 100, but these moving averages, started to flatten out, are now pointing upwards. We'll see. Maybe the data today, ISM services and the ADP will give us a bit more information about that. But the dollar index are pushing a little bit higher, so obviously the euro down and everything down a little bit. And no surprise that some of the risk-sensitive cross pairs, let's say AUD JPY, so the Aussie dollar versus the Japanese yen, that came off a little bit just on that risk-off tone. Let's see today, what's going to happen with the Supreme Court. We get those, and as I say, a bit of data and a little bit of Fed speak, and no doubt something from our friend in the White House. Okay, guys, I'm going to leave it there for today. Have a great trading day, and we'll continue this tomorrow. Thank you.